This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. One thing I wanted you to be able to elaborate on, you talked about quickly decide, right? If something fit or not. I even appreciate how you even said, how to be nice to the folks on the other side, right? Not every deal is going to work, but even respecting their time. Like, what are the questions that we need to know about this opportunity that's going to help you understand that risk reward, ratio there? About, how about we dive into that exercise a little bit? I'd love to know. I know the listener, I probably caught the listener's attention as well. The exercise that helps you do that. And then I know there's a number of things or a few other things we're going to talk about, but thankfully we have Alexa for a couple segments here at least. And so the listeners know, but elaborate on that, the exercise, right? So you can make some of those decisions quickly.
Sure. So I'll tell you two things. First, there's a reason why the exercise I think is important. Even though I advise LPs, I think LPs would not be in a good place without happy GPs and incentivized GPs, both from a fee structure and a promote structure. Now, you know, something I firmly believe in is being able to ask questions, and the idea that if you're not getting good responses, then you should not feel pressured to sort of give in and just invest. Um, the flip side of that is also really important because LPs need to be sensitive to the fact that GP has many investors, and all types of investors are asking different types of questions, and so you sort of need to do your homework before um, before realizing whether you want to ask questions or not, right? In other words, many times you'll look at a deal and you'll just know that it's not for you, whether that's because there are way too many questions and sort of like the probability of getting good answers is low, or perhaps it just doesn't meet your goal. For example, if someone wants a cash flow deal, and this is a development, and cash flows won't start for a few years, so like you can just pass immediately and not ask them 20 questions about the deck, right? And I mean, that's just a simple example, but there's many sort of uh, similar, but not as extreme examples that apply. So just to start the conversation, I think it's important um, to be sensitive to both sides. In terms of the actual conversation, um, what I think a part of the discussion today will I think, be an article that I put out, which is called the Top 15 Syndication Mistakes. What I would recommend that everyone do, and the reason why I put this together was I see the good and the bad from the LP side. Um, when you see a deal go sideways, you can almost always go back to the original deck, to the original model, and discern questions that you could have asked but didn't. And I'm not talking about, predicting COVID or something crazy like that. Um, but there are certainly things that should have been in your due diligence that weren't. And I think it's really important to simply look at all the factors of a deal together, right? And not pass too quickly. That's also really important. So meaning, on the one hand, you want to do this quickly, right? As we pointed out, Whitney, in the beginning of the conversation. On the other hand, you can't do it too quickly based on a variable thinking that it means something else. So I'll give you an example of both. Um, First, I'll just comment that as you're starting as a new LP investor, you should tend towards spending more time on everything and giving the GP the benefit of the doubt on everything. Um, until, of course, you have to ask and see what they say, and sort of have a healthy dose of skepticism, which is what I always call it, which is good for investors. Um, but but I think it's really important because investments are tricky, right? So I'll give you an example. Um, one thing I hear all the time is, hey, you know, isn't it crazy that I got a deal from a GP and there's a 50-50 split? Um, I couldn't believe that. Like, what were they thinking? I passed immediately. And I speak to the LP and I say, well, like, so? In other words, you didn't tell me enough information to know if that's good or bad. For example, let's say a standard pref split is like 7 to 8% pref, 70 to 80, and then the remainder in terms of the split. So, but let's say that the 50-50 split, I'm just making this up. But if someone says 50-50 split, I pass, but then you realize that the pref was 10%. It's like, oh, well, I probably should have looked at that, right? Or perhaps it's a 50-50 split, but the GP is contributing 50% of the co-invest. And typically it's way less. Right. So all of this is part of what I would call sort of like a um slow and steady, investment process. Um, and I think it's very easy to find reasons to pass on a deal, but it's not the way of the investor. Um, and yeah. So I think going back to your example
Yeah.
to circle back.
It's a
Um,
holistic approach, right? I mean, you're looking at many other
right,
aspects as opposed to just having a hard and fast thing that, oh, nope, the pref wasn't this, or the split wasn't this, or the fee was this. Well, there may be something else that's really good about this or compensates that completely, right?
right. And I'll just add again, the way that I started this was over time you get much better at this and quicker, right? So the reason why I wrote this list is as you get quicker and you sort of realize, oh, maybe it's a 50-50, but let me look at the pref. Let me look at the co-invest. Let me look at a few other things. And within a minute, you might be able to be like, well, okay, I know that it's not a 10% pref. I know they're only contributing 2% of the co-invest, et cetera, et cetera. And then you pass within, I mean, it could be a minute, right? But it takes time to develop that skill set and reps of being able to see the deal sort of like from a holistic perspective, I said.
Yeah, and I think that that goes right along with obviously this, the top 15 reasons to stop and think. Like the article that you wrote, because the very first thing is a syndicated real estate deal lower than 65% percent split to LPs. Well, that's one thing, right? And the next one's social proof. The next one talking about typical IRRs. Well, again, if you're looking at one of these things, right? Well, we need to ask some questions, right? But that may lead up to your second or first topic or point, right? To ask questions about some other things.
Right. And quickly, I'll just add, there's a reason why I call it stop and think. I wrote a little bit about that in an article, but for the benefit of the folks listening, it's precisely for that reason. In other words, if something, if your split is 50-50, so it doesn't meet my first criteria, but there might be a reason for that. So it's a reason to stop and think as opposed to just freaking out and saying, oh, red flag, I pass. Like that's just not how investments work.
Let's hit a few of these points, and we'll have to do it kind of quickly, but unfortunately, I know we could talk a lot about each of these in detail. But
Yeah, sure.
maybe you highlight a few of these, and then I would love to talk about you mentioned it actually currently advising on capital calls. I know there's many listeners or LPs that listen who would have a number of questions about that, and so maybe we talk about that too in another segment, and we'll dive a little more into those. But let's talk about a few of these at least at a high level, and so the listeners have a better understanding from your article. But maybe hit splits for just a moment. Like the typical, obviously 70-80%. But when would you be okay with that being different, and or what are some things the listener needs to be aware of?
Right. I think the first thing is just understanding why it's important, right? So when you invest as an LP, um, you're a silent partner, and you're essentially giving your trust to the GP to do the best job um, possible on a given deal. Um, the reason why this matters is because any profits, assuming things go well, um, any profits are split, and therefore, the lower the split to you, the lower the overall returns. And at some point, the returns. get so low, so to speak, in probability that you might as well sort of invest in an index fund or put it into treasuries or whatever. Meaning, um, you need to be compensated as an LP for the fact that you are putting your money in a fairly illiquid asset. You are a silent investor. In other words, the GP has more or less full control over what happens. And so because of that, there has to be sort of what's called a risk premium, right? Like you need to expect more of a return in order to compensate for that. So that's the basis of why it matters. Now, I think the most important thing to discuss here, I think, is the relationship between the pref and the split. It's pretty simple, but many times people miss it. I think 7 to 8% is pretty market in terms of the pref. For the benefit of the listeners, I'll just remind everyone because of conversations I have almost every week. A pref is not a guaranteed return. It can be stopped at any point. In some cases, it doesn't even get paid when it's accruing. So don't just assume that this is something that will get paid. And as an example, I always give the example of a development deal will accrue a pref, but it will not be paid current because there's no cash to pay it, right? Until they can actually pay it. So keep in mind that the pref is it's exactly what it says. It's a preferred return, but not a guaranteed one, and not necessarily paid in cash up front.
I try to
Or
make clear with every investor that it's the first portion of any cash flow. Right.
exactly, yeah. Yeah. And then, in terms of the split, I think they're related. In other words, that's another thing that I think LPs need to understand is, um, generally speaking, and this is sort of in a vacuum, ignoring everything else in a deal, which is a little hard to do, but as the pref goes lower, in other words, your preferred return to the LP is lowered, you would expect the promote to you as the LP being higher, right? And that's an important relationship. Again, and going back to our example, if you see a deal that is, let's say, a 10% pref, you're like, oh, okay, that's above market. Then you look at the split and it says 50-50. So then you're like, okay, that's below market. But now it makes sense why it's below market because the pref is above market, right? So these two variables sort of coexist, right? And I would also say that it's important, I think, to note, especially over like a, a short duration deal, right? And by that I'll say less than 5 years, right? Right. It's incredible how much people overweight pref, where like the additional 1% kind of doesn't matter. So don't, in other words, don't be the person that says, oh, I'm getting, instead of an 8% pref, I'm getting a 9% pref. And because of that, I'm willing to give up 50% of the promote. Like the promote in the majority of deals, especially anything value add related, is where all the value is held. And so your extra 1% is actually not that significant.
Yeah. No, I think it's yeah, we can't look at any of these things in a vacuum, right? It goes back to your very first point. But even with those things in mind, you're talking about split. You talked about the pref. I'd love for you to dive into even your third topic there on your paper, which I would also encourage listeners to look up. We'll definitely have a link in the show notes as well. But IRR, right? And I hear some passive investors or LPs say, you know what, I don't look at IRR, and some of them are like solely focused on it, or I've heard a lot of different trains of thought behind what they feel like IRR should be, or whether they should they focus on a completely different metric. But I would love your thoughts behind that typical range there, but then also how much focus you put on it.
Yeah. I mean, I think anyone that has looked at a model, and I always recommend LPs to look at a model, um, they can, with almost high certainty, understand why I don't recommend sort of like basing investment decisions in IRRs. IRRs are typically very weighted towards two or three assumptions in the model. One of the most sensitive ones tends to be the exit cap rate. In other words, the exit um, valuation of the property when you sell. And that both depends on sort of market cap rates at the time, but also the NOI that you're able to achieve, which itself sort of depends on your own assumptions, right? And and so because of that, actually, I very much I really try to tell LPs not to focus on IRR, because I think what happens is you sort of self-select um, the GPs. You're almost like you're biasing your own funnel into GPs that across a large enough sample size are somewhat aggressive in their assumptions. Like real estate, generally speaking, is not an asset class that returns 20, 30, 40% IRRs. And so when you're seeing really high IRRs, two things could be true. Either they're um, conservative assumptions, or they're aggressive assumptions. With high IRRs, it tends to be the case that more of them are aggressive assumptions. So if you sort of like have this funnel that says if something is in a 20% AR, it's not worth it for me to look at it. Then what happens is the bucket of things that you actually look at tends to be riskier on average. Um, Whereas the GPs that really think about numbers and are careful to, for example, assume cap rate compression and other things that might bump IRR significantly, so they sort of get um, lost in the tracks because like their 15% IR isn't high enough, so to speak. But the reality is it's only 15 because they're showing you a conservative case. There's certainly hope it gets higher. They hit higher than that, but they're just not comfortable showing that as the base case on slide 2 or whatever it is. So I hopefully that helps. I think
Yeah.
it's really important not to look at it in a vacuum.
Yeah, something that you mentioned there that stood out to me is you must look at what's going to accomplish that IRR for this project, right? It's like what's the operator counting on to gain that high of an IRR, and that
Yes.
one thing alone may never even happen, right? Or what's the risk of that one thing not happening, whether it's a refi, right, or big cash payout, right? Or they have to sell in year 2 to accomplish this IRR, and
Yes.
they may not, if they bought it last year, well, you're probably not getting that IRR that they projected, right?
That's right, and it's I always tell people you if you can't find the top three downside catalysts in a deal, you shouldn't invest. In other words, in any deal you're looking at, nothing is risk free. Real estate is not risk free. It's not necessarily safe. It can be if it's acquired right? But it's really important to understand that even the right investment can have challenges. And if you, as an LP, can't identify, let's say, the top three challenges that sort of have like the highest impact on your IRR and get comfortable with those challenges, so that you go into the investment knowing what could go wrong, then I just say don't invest.
Yeah, no doubt about it. I love that. Just thinking through a number of things that, man, what tells us that we shouldn't invest? And anyway, I want to be able to get to a couple other things here before we have to move to the next segment. But you laid out there anything higher than a 3% acquisition fee should be something to think about, right? I like that terminology. But then just fees in general, right? No clear outline of fees. I could not agree with you more. I want to be extremely transparent about where the funds are going, right? When we do a deal, I want every LP to know exactly, what we're charging or what fees the deal's going to have. And obviously, an acquisition fee is one of those. And you said 1 to 2% is common. Maybe elaborate there, on when you see a 3%. When you're okay with that. When is that okay, or when you've seen higher than that even.
Yeah. So actually in the same top 15 syndication mistakes article, I sort of outlined the fact that At some point, a GP has so much experience and success that they could sort of stray away from the pack, and charge more. Just because, I mean, at the end of the day, fundraising is a supply and demand story. And if you can charge more, and I don't even want to say get away with it. Like there's nothing. I mean, if you're delivering amazing returns for your investors, you deserve to get paid more than the guy next to you who doesn't have that track record and abilities. And the example I pointed out is Renaissance, which is not in the real estate world, but I think they're sort of uh, a guiding light, so to speak, in this world of extremely high fees, but an impeccable almost track record. Um, in terms of fees, as a general point, I'll just remind listeners especially in LPs, um, the reason why fees matter, and I actually have an article on this. It's called "Why Acquisition Fees in a Syndication Matter." Um, the reason why they matter is because as soon as you place your money, you're immediately down on your investment. So, for example, if and this is a big misconception that I just want to address right away. Many times people say, "Oh, what's the big deal? It's just 6%." Well, 6%. In other words, what's the big deal of being 6% down on your investment day one? The reality, however, is if you do the math and you realize that the 6% isn't of equity, it's of purchase price. And that purchase price is levered, right? So, for example, if you're investing in a deal, and I have a whole table in that article, if anyone wants to see it, but if you're investing in a deal at 6% acquisition fee and there's 75% leverage, so that means day one, and I'm ignoring all other fees, closing costs, sometimes there's like personal guarantee fees, all types of other things. Um, if you're 75% levered, your money is down 24% day one. So you literally lost 24% of your money. And of course, I hope you thought about that and you sort of recovered because the investment is so good. But the impact of my point is the impact of fees is like very real when you look at it. And I think you should be aware of, of sort of where your money stands day one as you go into the transaction. And in terms of market rates, as I said, I think 1 to 2% is common. 3% can be seen sort of like on much smaller transactions as a percentage of purchase price. The percentage sort of tends to go up a little bit. Above 3% is like pretty rare. It happens. And I think generally speaking, um, one of two things is true. I'll just be candid. Either the GP is just like a phenomenal GP that can get away with it, so to speak, and deserves that, or to be candid, this is more often the case. The GP is dealing with sort of like a retail base of investors that just don't know any better. Like they just see it and they're like, "Oh, real estate, cool opportunity for me, amazing," and they just don't even understand what the fee means. They just see the IRR, passive income story, retire from your 9 to 5 or whatever, the best slogan is, and they just put their money, without understanding it.
Yeah, I've seen it both ways as well, and even as a passive investor myself, and have questioned maybe a higher acquisition fee, but I figure out, hey, they've done this. They've had 30 successful deals, or I mean, like there's a track record that supports that or builds my confidence in a way that I'm willing to pay it, right? Uh,
Right.
um, but I would say that's not always the case.
It's not always the case, and I think I would say just from my experience, when you go above 3%, I would say it's more often the case that there are issues
Yeah.
um, with the GP or the deal or both. It certainly happens that there are exceptions to the rule. Um, and while we're on fees, by the way, I just want to mention fees are there for a reason. In other words, I think many LPs don't understand this. Um, the GP typically puts in months, sometimes a year plus of work, deal after deal to get into something. that they're presenting to you. Hopefully, this is not always the case, but hopefully they thought long and hard about this deal and passed on many others in order to get to this one. And so there's sort of like the sweat equity built in. But in the meantime, they have an analyst and an associate and a VP and the CEO and the principal, whatever. Like people need to be paid. And so sometimes you lost money during diligence on a prior property, which you decided to walk away from to be, an ethical GP. Right. So like there's a reason for fees. The reality is the GP runs on fees as a company. And so they're super important. The answer is both. In other words, a GP needs fees, but the LP also needs to understand how the any fees that are being charged, A, what are they? Because sometimes they're not clear. And B, how do they impact your investment?
You're advising a number of LPs, right? But a lot around capital calls right now. And I know there's many listeners who have questions about that. They've received that call that they were hoping not to ever receive, right? Or they may not have even known it was a thing, right? I mean, really, they may not have even thought that was ever an option. And all of a sudden they're getting a call from the operator they partnered with, that's needing some capital, right? And so and they don't know how to assess that, right? Should I do this? Should I not? What does this mean? And I'd love to give you a minute to, even walk through some of those things or some of the questions I
Yeah.
know you're having LPs ask you, and how to assess, should I put more money in, or should I not? And let's talk through that a little bit.
Yeah, sure. So I guess first I'll just define capital calls because I think there's some confusion.
Mhm.
There's something that I would call an expected capital call and an unexpected capital call. An expected one is typically as a result of like investing in a fund, for example, or maybe a construction project where at the outset you and the GP had an agreement that they'll pull on, I don't know, a quarter of your principal every quarter for a year or whatever it may be, or as necessary. So if a GP reaches out to you in that case, um, other than sort of understanding what's happening, et cetera, and the economic landscape and the viability of the deal, which I always recommend, those aren't of particular concern, and those are not generally what's being discussed in the marketplace today. Um, what I spend a lot more time talking about, both publicly on my Substack um, and also just receiving calls from clients, is the unexpected ones. In other words, you bought into a transaction. You and the GP, hopefully, both had the intent that the deal was fully capitalized day one. In other words, no more capital would be needed. To your point, many LPs did not even understand that getting more capital was a thing, right? Because it was just so obvious that, we bought the property. Like, well, why would you need more capital? So now fast forwarding to today, obviously the past 2 years have been pretty challenging for the real estate markets, and as a result, a lot of LPs are getting capital calls. I think what I would recommend from a decision perspective, um, is first just I would always say just take a step back and realize that what's in front of you is an investment opportunity. Like this is not an emotional thing. Um, this is an investment, and you can either decide to invest or not. And that sounds silly in a sense, but I can't tell you how many times I get calls from LPs almost freaking out because if they don't invest, they're going to get diluted. If they don't invest, maybe the thing is going to end up in foreclosure. You sort of have a lot of different communication styles from GPs, ranging from very transparent and honest, and well communicated, right, early, all the way to like complete surprise, um, like, we're going to lose the property in a few days if you don't send the money now. We don't even have a plan. Like I've seen everything, and some of it is healthy. A lot of it, I would say, is pretty not healthy and not enough information to make capital calls with. So just again, know that it's an investment decision. Know that just like at the outset, when you were able to ask questions to the GP, so similarly here, like there's nothing stopping you from doing diligence. and asking questions to the GP. Right. That's the first thing I would say as a broad strokes. And if you sort of want to go through the typical steps that I go through, I'm happy to do that too.
Yeah, nothing stops you from asking questions. I think it's great to just pause and take a breath, right? And like you said, take a step back. I appreciated that stance, and even I've not heard anybody say it like that. You know, realize that what you have in front of you is an opportunity or investment opportunity, right? You can invest or not, right?
Yep.
And try to assess is this still a worthy investment to move forward with or not. I would love for you to elaborate a little bit or us dive into some of those questions because there may be a time you do want to continue.
Yeah. Yeah, exactly. So typically the steps that I go through they're pretty simple. And you'd be surprised at like how quickly things weed out for many people. The first one might surprise you. It's like, do you actually have the money liquid? Um, I've heard people like they wanted to pull on their 401k, which would be sort of like that would be needed to pay back with interest if they did that. I've heard people wanting to sort of like borrow from an uncle or mom or whatever. And all of that is I'm not saying that's good or bad. It just further complicates the equation. In other words, if you have the money sitting in your bank account and you don't need it per se for any emergency, that is sort of like step one. And many people don't even pass that stage. So that's I think it's a kind of a silly place to start, but it's also like a really important place to start. Um, um, the next thing is I would say, like you have to understand legally what happens if you don't invest. Um, in other words, um, what is the cost to you, so to speak, for not investing? And this differs across GPs. I think some GPs are what I would call um, I guess you can say like more favorable to LPs, and they say, look, like we kind of messed up here. Um, we're not going to dilute you if you don't invest, but if you do invest, like here's kind of like the upside that you can participate in. So that way you know that if you don't invest, the worst case scenario is you just get diluted by the new investors, but not penalized for not investing. Um, and those two things are very different. Like you're obviously going to get diluted by new equity, right? Because if you don't contribute, like your shares will naturally get diluted. But that is very different than getting diluted because you didn't contribute to that new investment. Those are two separate things. And it's important to just simply understand, legally speaking, what will happen if you don't invest. And again, you'd be surprised how many sort of like capital call emails I've seen. Honestly, it's probably more than 50%. Um, where the GP emails the LP, of course, it's sort of like um, a mail merge across all the LPs. Many times this is like big funds that I think should know better, but they just don't state what happens, like in either direction. Whether it's good, so to speak, and you don't get diluted if you don't invest, or bad, and like you really get penalized. And oftentimes the legal agreements are actually not super clear on these matters. So it's really important to get clarity there. I guess let me stop there. Before I continue, I have a few others, but any questions on
Yeah,
those
no,
two?
I love your stance on it too. I mean, like I said, taking a step back, but then thinking through these things, and it's interesting, you talk about something as simple as, well, do you have the money to invest? And you also mentioned, I like this, and if you do have it liquid, are you sure you don't need it yourself,
Yeah,
right? Is
yeah,
it ready to just deploy somewhere? Because if not, then it's kind of a pointless conversation, right?
yeah,
Yeah.
yeah, exactly. And at that point, like I mean, it's perhaps painful to realize that, but it's like, um, if you need the cash for something else, or you don't have it, like I mean, there's just no decision to make.
Right.
And you sort of like take yourself out of that decision. Um, um, yeah, okay. So once you realize, or I should say, understand what the implications are, um, to not investing, The next step I would say is just understanding where your existing position sits. Like to put it simply, let's say you invested 500 grand. Uh, do you still have 500 grand? Do you have 700 grand in there or a million because like the property is worth a lot more? Or perhaps do you have nothing? Um, and and this is a whole article that I wrote at length about, which deal the article, I think it's called "Do Sunk Costs Matter in Capital Calls?" Because there's sort of like this, I think, dishonest connection between the last investment um, and and the new investment, the capital call, sort of marginal capital, um, in that you almost want to just forget the last stuff and say, oh, that's a sunk cost. I'm just going to ignore it. Um, I'm just going to focus on in whether I want to invest today or not. But the reality is, I think as far as capital goals go, it is true that it's a sunk cost. You can't get the money back. But these things are actually extremely connected. And knowing where your original position stands and sort of like how you can get that money out and the business plan for that should have very direct consequences on your plans on returns for the capital call money, which you could invest in a new syndication if you wanted to, right? Like that 100 grand, let's say, like I'm just to give an example, like you invested 500 grand, and let's say, um, sadly speaking, by the way, Whitney, I mean, this is probably more often the case than it's not. People call me not being sure what a capital call is. Um, in the middle of that conversation, as I help them with diligence, it becomes apparent that the 500 grand that they invested is gone. Like it's not officially gone, right? Because the property hasn't sort of marked to market and sold. But in terms of the equity worth, um, based on sort of like a realistic um, outcome or outcomes, you can even sort of like do a sensitivity analysis, whatever, like it's essentially gone, right? So at that point you have to think that, you know, um I they want another 100 grand relative to my original 500 grand. That 100 grand I can put into treasuries today and make 4% or 5 or whatever. um I can sort of invest it in the stock market. I can invest it into alternatives such as syndications. And that is a totally new bet, new GP potentially. Um, and perhaps that's a good investment. So what is going to convince me, and this is important, like you should be convinced, just like you were convinced with the original deal, you should be convinced that doing the capital call is a good idea. And so what is going to convince me that the 100K is going to earn more by reinvesting it back into this property compared to investing it elsewhere, right? And the original status of that position is pretty important in that analysis because I don't know if I want to get into the weeds. This might take a long time, but for anyone that wants to sort of see this live in a model, again, I would recommend the article that I wrote specifically on this, which is "Do Sunk Costs Matter in Capital Calls?" There's like a literal model that I go through to explain how these things are related. Um, and look, and the last thing I would say is just how do you know, and this is like probably missed at least 50% of the time, like, are you sure that this is the last capital call? I mean, in other words, I can't tell you how many times um GPs will sort of like freak out and look, I want to be sensitive. Like it's scary to be a GP in difficult times. It's like that's probably another episode in its own right because I've seen it from the inside and like um you sort of like sometimes a GP will react to a piece of news like like we can't pay debt service next month. Oh no. Okay, we need to issue a capital call. Okay. But then from an LP perspective, like all of that is understandable, but from your perspective, you need to know, like, is there a plan to ensure that we're not going to need another one, right? And that another one might be because in 6 months the rate cap expires, or in 6 months we're going to have some other issues, or if there's a refinance, and instead of a cash out refinance, it's going to be a cash in refinance, which is another topic that I think LP investors are sort of like learning slowly. So yeah, let me. I know I kind of said a lot, but like
No, it's
those are
good.
generally the steps that I go through.
I love the questions that you're asking, and I think every LP needs to know these questions, especially in what in our economy right now, as many of these are happening, unfortunately, across the industry. And but it's interesting you talked about has your investment going up or down, right? What is your position currently? And I think it's a I would think that most assume that it is gone, right? More times than not, or when would you see the position? Um, you know, Favorably, right? They invested
Mhm.
the 500K, but there's a capital call and their current position is 800, or 700
Yeah,
or
I think there are actually quite a bit of examples like that. I do think it's the minority. But I'll just give you an example. A developer is developing a brand new apartment building. They're 2 years in, and they're like just a little bit over on costs. So they're like 90% done, almost done. Um, but it's a phenomenal area. The apartment, so to speak, from a valuation perspective, is well in the money. And they just need sort of like the 10%. Maybe half of it will come from construction loans, right? From the existing, but like the lender didn't want to put up the entire percentage because of going over budget. And so there's like a tiny capital call to get them to the end. But like as far as the business plan goes and the overall valuation, things are more or less. I mean, they probably got impacted in the past 2 years, so it might not be the 2.5x multiple you expected. It might be a 1.5, but like you're probably in the money still, right? Whereas what's happening a lot of times now is like to your point, I think probably the majority of the calls I get, and that might be there might be some bias there in terms of people calling me for certain reasons, but certainly the majority of people that call do have their either wiped out equity, or it's like at least let's say 50% impaired.
yeah, yeah. No, I just wondered, or if you see any. That's a great example, though. A development type projects. Obviously, there's no cash flow, right? And they may have had more expenses than they expected, or something like that. But I wondered if you see that at all in a typical value add deal or some kind of already a construct something that's not a construction type project.
Yep, exactly.
And let's see, you said yeah, and is this the last capital call? Great point as well, in thinking through anything there that would help you to determine that, because I think that could be hard to determine for most LPs, right? They're not going to be as sophisticated as you at underwriting to think
um
through, well, how would I know, if this is going to be the last capital call or not?
I mean, the first thing I would say is just ask the GP, and as always, don't ask them in a yes or no way. That's a whole kind of topic that I wrote another article called 26 questions to ask your GP. The introduction to that article, it sounds funny, but it's like, how do you ask questions? And the way to not ask questions is yes, something that can have like a very minimal information as far as the answer. So the way not to ask the question is, do you think this is the only capital call we'll need? Or even worse, do you think this capital call will be enough? Like enough for what? Right? And or in other words, perhaps a better way of asking the same question would be, um, hey, I appreciate all the information, blah blah blah. I noticed in the deck, I'm just making this up, but like I noticed in the deck that the uses, in other words, what the capital will be used for, um, is for cash flow constraints today. In other words, like operationally, the property is sort of underwater. Because let's say, they're in the middle of rehabbing the units and they're not cash flowing enough. But I also noticed on another slide, you mentioned that we have a capital call coming due. I'm sorry, a rate cap coming due, at the end of next year. So what is your plan on the capital call? Or we have a maturity coming due, a debt maturity. So like, what is your plan on the refinance? Unfortunately, these questions aren't so simple. Whitney, I think it does require a certain one is just experience, but two is just being thoughtful and yeah, I
Yeah.
guess just being like really thoughtful and thorough. And I think I'm hoping you were thorough at the outset, right?
Right.
And my bigger point is you should be just as thorough, or maybe more thorough, I would argue, at the point of a capital call, because at that point, um, I'm not here to point fingers. Like there's a market change that happened, right? But at the end of the day, like something not good happened, and the same person that was a steward of that capital is now asking you for money. So sort of like the level of knowledge that got you to invest the first time should be not enough to get you to invest again,
Yeah.
right? Like you now have new information that I think should require you to sort of like inquire more and understand more.
Like you need to re-underwrite the deal, the opportunity again, all over.
Yeah, yeah. And look, I think that's sort of somewhat unrealistic for like an average LP, but I would say at least understand the catalysts, right? And understand what could go wrong.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.